Now, yesterday was pretty much red right across the board, although one industry that didn't look too bad, notably Nvidia and AMD in the semiconductor space, up around 4 to 7%, and there are no surprises as it is now expected that both of these companies are going to be able to ship their chips into China, something that Donald Trump actually had stopped not that long ago. And if we zoom out to 2025, we are seeing lots of green across the board. Also, semiconductors, in fact, green double digit. We've got the likes of Micron up 43%, Nvidia up 27%. And as we've mentioned to you already, we are now expecting a very volatile time. We have earnings officially kicking off. Now, under the spotlight, and for very good reason, as we're going to get onto, is ASML, which has reported just hours ago. And remember, a quick reminder that we are expecting many other companies in the upcoming weeks, so make sure you are subscribed, notification bell is in fact on. Now, ASML has come to our attention as it is down in the pre-market around 8%, something we wouldn't typically want to see for what we believe to be a high-quality, high-moat company, and over the last 12 months, it is already down around 23%. Having said that, year to date, it is up around 19%, although a lot of these gains will now be eroded, and longer term shareholders, well, you would be up 735, outperforming the S&P. So with the drop, we are expecting this to come in the mid, perhaps towards the lower end now of the 52-week range, but both Wall Street and Seeking Alpha still believe this is one for a buy, serious consideration at least, in the portfolio. Now, before we get into the earnings, we also want to highlight this company is still severely undervalued. The forward P upon market open will now drop into the 28-29 region, which is well below the 5-year average, touching 34. That in itself to us is an undervaluation signal. And if we couple it with the blue tunnel here, which does tell us the expected intrinsic price, we can see it is sitting outside. Disparity will be even further upon market open. Again, another undervaluation signal. Although worth highlighting, over the last 12 months, this is one that for the large part has been undervalued. And if we were to zoom out to the last 5 years, what we really want to draw your attention to is that the expected price over time has been increasing. Always a great sign and pretty much a must for any company you're investing in, but the company itself very volatile. There were periods, we're talking 2020 to 2022, where it was trading severely overvalued. So perhaps if you believe in the longevity of the company, this undervaluation could be a great chance to buy the dip. Although pretty important to mention, the company does trade above the sector at 24, so you are paying a 24% premium, and as we just highlighted, against their own 5-year average, it is lower, sitting around 25%. Now, the earnings themselves, very strong. Top line, 7.7 billion euros, which is up 23% from the same quarter last year. We also love to see efficiencies to their margin, not something many investors focus on, but we would say equally as important as growth across the board. 2 percentage points improvement to their gross margin, 5 on the operating and 4 on the bottom line. They also do expect for the next quarter to sit at double digit with Q4 at 3%, although they're anticipating, as we're going to get onto, a bit of an issue in 2026. Nice to see now for the last 5 quarters, they've outperformed each one against analyst target. 100% track record with forward P estimated around the 26 region for 2026. Now, something that has got investors very scared, and the main reason for this large drop is that whilst they have performed a double beat, they're saying there are some issues that they will be facing in 2026, and that is why they can't confirm if we will see any growth. Now, that does seem very far-fetched for a company with an enormous moat that has been looking strong quarter on quarter, as in fact we just said to you now, they have outperformed over the last 5. And probably no surprise to see that one of the issues they are discussing is uncertainty with US tariffs. Now, bear in mind, earnings season has just kicked off. Do not be surprised at all to see this come across many companies, not in fact just the semiconductor space. And remember, if you have cash on the sidelines, you're looking at high quality companies, we could see a wide range of dips. Now, they said for 2025 they're expecting top line growth of 15%. Now, this isn't something that they have lowered, but interesting to see here that it is a narrowing of their initial guidance. So over time, they're actually getting a little bit worried in terms of their top line sales. That is something that is also going to be seen in 2026. And as we said, pretty much the main driver for this near double-digit drop, they are uncertain about what 2026 is going to look like. That is even after they're coming out to say that their AI customers' fundamentals still remain very strong, but that they see increasing uncertainty driven by macroeconomic and geopolitical developments, and that while they still prepare for growth in 2026, we cannot confirm it at this stage. Now, this is unsettling for both investors as well as prospective investors who are considering to buy the dip. We're going to get into our own valuation shortly as well, which has been updated to reflect this. And as we said, they have pretty much, as they consistently do, performed a double beat. So on the top line, 7.7 billion euros. That is nice to note when the forecasted was lower at 7.52. And in terms of the net profit, 2.29 billion versus 2.04. Again, something we always love to see. Double beat. Company in terms of share price is dropping, could be looking like a great opportunity. And we can see they reported between April to June net bookings at 5.5 billion, higher than analyst expectations of 4.19. So question is this all noise or should we really be concerned? Something we want to uncover today. And we can see Bloomberg coming with the point of view that this could be a great opportunity to buy because they focus on the fact that they have outperformed in terms of expectations and that AI investment, as we've heard from many companies, including the likes of Nvidia, continues to fuel this very high demand that doesn't look to be stopping at least anytime soon. Now, speaking of ASML and their wide moat, perhaps this is something that is also coming into question. Can China build their own ASML? And we're also going to reflect on how dependent this company is on their sales to China. As we note here, Beijing wants 100% domestic chip equipment, but as of now, it is a little bit of struggle to really see this come into fruition. And yes, ASML is in fact expanding, but we can see there are companies here that are really trying to erode their moat and bring in some strong competition that will hopefully, over time for themselves, see revenue pick up away from ASML. And this is something that has been going on quite a continued basis. We have Cyclicality here that are working on machines that they are looking to eventually at some point replace ASML's equipment. Now, that hasn't come up in the net bookings as we've seen, but this is things that we always need to keep in our thoughts, and that is why when we get to our valuation later, we will be using a margin of safety. Important to understand as well, company is cyclical. They had 18% growth in terms of revenue last year, which was above the sector, not far off their own 5-year, and that is seen in the drop expected into the next 12 months, although we did just hear they expect around 15%. Whether or not we do see it as low as 10 to 11, something to consider. Nonetheless, above the sector at 7 and their own 5-year sitting at 16, if they can hit that 15%, then it won't be too far off. In terms of earnings per share, projected 17% growth over the next 3 to 5 years, above the sector at 14, but below their own historical at 22. And one thing we should never forget with this company, their profitability very strong at an A+, but we just highlighted in their most recent quarter, they're improving their margins, such a fantastic quality, and that is why we would say this is, at least for the time being, one of a high quality. Gross margin 52%, above the sector at 50 and their own 5-year average. Bottom line, absolutely phenomenal at 28.3%, well above the sector at 4, and also improvement to their own 5-year average. So they're increasing revenue, they're also increasing the margins, and they're also, on top of that, generating more cash from operations as time goes on. 12.3 billion, around 50% higher than what they have done 5 years ago at 8.2, and well above the sector at 116 million. Now, in terms of their sales breakdown on a quarter-by-quarter basis, we can see 5.6 billion euros in the most recent one, which is a slight drop from the previous quarter. However, what we want to highlight here is a dependency on not just China, but also Taiwan, which also brings into other factors in terms of geopoliticalness. And we can see, in combination, last quarter, we have here 43%. This is now increased, and this in fact is why we're saying, could their moat erode? Something always to have in the back of your mind. Whether you believe that or not, definitely something to consider. But this quarter, it has in fact increased in terms of dependency. We're talking around 62%. Now, net bookings improvement is always a great sign for a company that we have products here worth hundreds of millions of dollars, and it's up from just under 4 billion in the previous quarter to now sitting at 5.5. And one thing that is overlooked by this company, we see it all the time, yes, they are paying a dividend, which is great to see. For the large part, it is up double digit, but what they're doing on top of that is share repurchase, which is a great way to return excess cash to investor pockets. And in fact, when we go back as far as 10 years ago, the vast majority of the cash that is returned is actually in the shape of share buybacks. And yes, they do have a share repurchase scheme. We can see 12 billion euros expected in 2022 to 2025, where they are currently sitting around 50% of those bought. But what's even more fascinating to see, how many shares did they purchase last year? Well, in fact, none. You'd have to go all the way back, in fact, to around 2023 to see when they started buying. Average price during that point, around the mid 600 euros. Then they've waited pretty much until the beginning of 2025. We're talking here the end of January to start buying. They went as high as 715 euros, really highlighting they've been buying nearly every single week. In just the last few days, they bought back 91,000 shares. They've spent around 4.7 billion. Yes, it is part of their program, but what is really a telling sign, the majority of this is coming in 2025. If management are buying right now, perhaps they see this as an incredible opportunity, and we may see this ramp up a lot more as the share price drops. Just take a look when they did buy the most. We're talking when it was around $569, telling us this is a good indication to consider management's thoughts. And we can also see expectations for the next quarter. Again, cyclical business, so we don't expect every quarter for it to increase. As highlighted, management are expecting around 15% growth. That is the same as their own 5-year average. But really, we need to drill down that this company is cyclical if we look at their free cash flow growth. Yes, we want to see consistent over the period. Actually, what we're noticing is an expectation of a drop over the next 12 months. Also reflected when we look at the sales growth. Yes, more often than not, very, very strong. But you can see there is no consistency. Just the last full year, it was sitting at 3%. In terms of their total sales, very strong growth over the period. We're talking nearly 5 times. But what's the best thing to see? Well, shares outstanding decreasing. They've bought back around 10% over the last 10 years, something that is only going to increase over the next few months as they do fill out the rest of that buyback authorization program that is expected to end by the end of the year. ROIC also very good, above the 12% noted for semiconductors at a bare minimum, increasing over the period, 38% on a trailing 12-month basis. And remember, as always, we want to see a bare minimum of 10% just to give us faith management are able to effectively allocate their capital. Margins, minimum 60%, well above that. Efficiencies noted from 30 to 34%. And free cash flow looking very strong, 30% on a trailing 12-month basis. Now, final thing here is the net debt to EBITDA below 1.5. Remember, this correlates to balance sheet strength. And what we do want to point out, these are the number of years it would take the company to pay off all of their debt, highlighting over the last 10 years and over the next 12 months, it won't even take ASML one day to pay it all off. Also interesting to see that institutions with their 26% ownership have been selling 10 billion worth of shares in the last year, buying back about the same amount, and we also see that trend continue into Q2. So overall, there's no clear pattern that institutions are bullish or bearish on ASML, buying and selling pretty much the same. But if we were to look at super investors to try and find a pattern, well, 7 of them actually hold ASML in their portfolio, and in the most recent quarter, as we've said, some of them have started to trickle in. We see the Hillman Fund reducing their position by around 33%. Now, in the previous quarter, we actually got some new buys. Pat Dorsey, very famous, opening up a new position, adding 71,000, as well as others, but we can in fact see it is one of those that super investors both buy and in fact sell. Now, we also want to understand, how does the performance compare against the S&P? Has it been outperforming? But as someone has mentioned, it is a good idea to also incorporate some of these comparisons against the QQQ. So that is what we're taking a look at. ASML over the last year down 22%, S&P up 11%, QQQ up 13%, so it's underperformed on both accounts. And when we zoom out to the last 5 years, it's up 129%. Remember, this includes the dividends reinvesting, outperforming the S&P 94%, marginal outperformance of the QQQ up 120%. And then when we zoom out even further, up 820%, outperformance of both S&P 200% and the QQQ up 441%. Bear in mind though, as always, past performance isn't an indicator of the future, but great to understand where you do see this in 10 years' time. Likewise, we like to compare this to others in the sector, similar size as well. Main reason is to understand whether or not the good performance or the weak performance is something isolated to the company or in fact the sector. Over the last year, down 22%. We also see Applied Materials down roughly similar. Lam Research also down. In fact, KLA Corporation, the best one. In fact, the only one up 10%. So yes, ASML has been very poor, but also this sector hasn't been the best in the period. Over the last 5 years, things do change for the last part, where ASML is up 129%. Very respectable, but one of the worst actually when you do see how others have performed. And then we zoom out to the last 10 years and we get the same thing here. Yes, incredibly strong. You'd probably take this if someone said 820% to your portfolio in the next 10 years. But actually, in comparison, others have performed very strongly. We're talking in the quadruple digits. And finally, before we get to our own valuation, we want to understand the cyclical nature of the company. Top line revenue, as we said, has been growing over the period, very respectable indeed, going from 7 billion to now sitting at 30. But we want to understand and reflect on the bottom line net income. Does it follow suit, or are we seeing a cyclical trend? And no, the answer is we are seeing strong growth comparable to their top line revenue. Net income 1.8 billion, now sitting at just under 8. Likewise, a quick health check, total cash versus total debt, where cash has gone from 3.8 billion 10 years ago, now sitting at 10, so pretty much a triple to the number. But as always, we don't look at any one number here in pure isolation. It doesn't give anything away, so we compare it to their total debt numerically and directionally, which for the large part has increased over the period. 1 billion 10 years ago, now sitting at 4. But remember, cash was more than double of this current total debt, and as we said, it won't take ASML one day to pay off all of their debt net of cash on hand. Balance sheet still looking very strong. Now we want to let you know we have also released our latest free weekly article. We drop one every single Monday morning to your inbox where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to a severely undervalued spreadsheet of stocks in July. Lots of information for each one, the upside that Wall Street themselves see over the next year, as well as a recently released just yesterday copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now updated intrinsic value gets to $909 derived from the DCF model. Now we'll just explain how we got there, where we have the free cash flow year on year. Average growth sitting at 41%, but we can see a lot of variances on a year-on-year basis. Some years very high, some years massive drop. Now moving forwards, we've lowered our initial growth rate to 12%. We can see we have a low, medium, and high, 10, 12, 14 respectively. And as always, these numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's ASML or any others. But based on 12% and the discount rate, we get the present value of future free cash flow and terminal price. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to $909, indicating 21% upside. Now we have lowered this given the fact that management are hesitant to explain the growth rates of 2026. We also have their moat coming under question, which will ultimately affect their numbers, so we do want to be a little bit more conservative. We'll also reflect at a 10% growth rate, we can see intrinsically $791, and if we were to use 14, 1045, indicating 39%. We've also got the reverse of the discounted cash flow model to highlight what is already baked into the numbers, currently sitting at 9.3%, meaning if you're buying this company right now, that is where the current price is reflected, growth at 9.3. Now remember, typically on the channel, we do want to take through the middle rate, which today sits at 12%, and we're not done just yet because we always like to apply a margin of safety. 10%, we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today, a buy at 819, then we keep going till it's near the current trading price, and in essence, not a 20% MOS just yet. We're saying somewhere between 15 to 20. Now, Wall Street have been lowering their price target, but on average, see this at $900. That is upside of 20%. Now give us your thoughts on the earnings expectations of 2026, potential erosion of their moat, and will also reflect at a 20% MOS, a buy at 727, at 25,682, and at 30,637. As we said though, right now sitting somewhere between 15 and 20, upside 20%. Do you see ASML as a buy, hold, or avoid? We'll also show for those that believe 10% the low rate to be more appropriate, that you're not getting a 10% MOS just yet. In fact, it's sitting bang on 5%. So also give us your thoughts about the most appropriate growth rate. Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.